In early 2026, Elon Musk's net worth hit a number that broke the scale: $800 billion. Adjusted for inflation, historians estimate that Mansa Musa, the 14th century ruler who controlled nearly half the world's gold, held a fortune of roughly $400 billion. Musk effectively doubled that. Yet this is a man who frequently describes himself as cash poor, someone who was just hours away from personal bankruptcy back in 2008. Going from near ruin to eclipsing the wealthiest rulers in recorded history required abandoning almost every accepted rule of personal finance. Look at Warren Buffett. He is the standard for safe, traditional wealth building. This chart shows a classic 70-year timeline of traditional wealth accumulation. It is a smooth, predictable staircase upward, built on diversified assets and slow compounding over decades. Now let's map Elon Musk's trajectory over that same timeline. For years, his line stays flat, hovering near zero compared to what happens next. Then, starting in 2020, the line violently shoots into a near vertical J-curve. Over a mere 15 months, his net worth spiked 300%, blowing past the $500 billion and eventually the $800 billion marks. That sudden vertical launch is the mathematical result of an intensely aggressive, hyper-concentrated strategy, where every chip is pushed to the center of the table. In 2002, eBay bought PayPal, leaving Musk with a $180 million payout after taxes. Standard financial advice dictates that you take a windfall like that, spread it across index funds, and live comfortably. Instead, Musk drained his entire payout to fund new, highly speculative ventures. He split those remaining funds into two notoriously difficult and capital-intensive sectors: commercial aerospace and electric vehicle manufacturing. To survive in these industries, his companies employed a strategy called vertical integration. This means keeping the supply chain almost entirely in-house, designing and manufacturing nearly every physical component themselves rather than relying on outside suppliers. Mastering that physical production allowed Tesla to outpace legacy automakers, eventually driving a 1,100% surge in its stock price between 2017 and 2022. Software is relatively cheap to build and easy to copy, but mastering heavy physical infrastructure creates a moat that competitors struggle to cross, allowing the company inside to scale its valuation relentlessly. Today, that risk is spread across a massive corporate portfolio. The most public financial engine is his roughly 13, but the anchor of his fortune is insulated entirely from the public stock market: SpaceX. By deploying the Starlink satellite network, SpaceX transitioned into a global telecommunications utility. That utility status pushed SpaceX to an $800 billion private valuation in late 2025, and Musk personally owns 42% of it. Surrounding these giants are multiplier companies like xAI and the social platform X, which constantly consume and train on the massive amounts of data generated by Tesla's cars and SpaceX's networks. It functions as a completely integrated web. A breakthrough in artificial intelligence for xAI directly improves Tesla's autonomous driving, multiplying the value of both companies simultaneously. Almost none of this exists in a checking account. This is paper wealth, meaning his fortune is strictly tied to the fluctuating value of company shares. This diagram shows exactly how billionaires access cash without selling shares. By depositing stock certificates as collateral, they borrow liquid cash from a bank. Since loans are not considered income, this process entirely bypasses the income tax toll gate. Because it is all tied to equity, the numbers can swing violently. Musk lost $200 billion on paper in 2022, and weathered another $126 billion dip in early 2025. Those multi-billion-dollar drops would ruin a normal investor. Here, they are simply the mandatory cost of holding absolute, concentrated equity in dominant hardware monopolies. Musk's trajectory represents a departure from the steady accumulation of past industrialists, favoring a high-velocity approach to risk. This specific brand of wealth is generated by building a sprawling, interconnected technology ecosystem that links physical hardware with digital data. To reach numbers that rival ancient emperors, he traded the absolute safety of the staircase for the extreme, volatile gravity of the rocket.